Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Welcome to this edition of Brilliant Investment Thinkers. Daniel Kelly, Chief Investment Officer, Viola Private Wealth. How are you?
I'm good. I'm going to refer to myself as that now and my friends and family, that I'm a brilliant investment thinker. So thank you for the early compliment, but that's good to be here.
Well, let's just give everyone that's engaging with this a little bit of the story. How did you come to be the CIO of Viola Private Wealth? What does it look like?
Yeah, I didn't take the traditional route that you'd probably expect, where you kind of do an MBA and you go into kind of a grad program and you end up in a role like I have now. I started at the grassroots. So my first job was a long time ago with Westpac in the branches as a personal banker. And I'll forever be grateful of the experience that I gained during that period, because you understand what the real world is like, what the real economy is like. You know, when you've got an elderly grandmother that wants to withdraw $30 from their account and they've only got a balance of 20, you kind of understand how real Australia lives. I progressively worked my way through a bunch of roles, eventually ended up in Westpac Private for a number of years, 4 or 5 years, understood their investment model. I left to join Credit Suisse, 250-odd-year-old institution, and I chose its last 2 years. So I was at Credit Suisse when it went under. Which was very difficult for the clients. It was very difficult for the other advisors that was there. But I was very grateful for the experience that gave me, because I was too young to be investing through the GFC.
Sure. Yeah.
So that was kind of like my own career personal GFC, if you want to call it that. And you really find out what matters to the clients when the bank that you are representing is going under. And so the cash that we had, ironically, the cash that was in the clients' portfolios was the most risky asset class, because that was, one of the own assets that wasn't ring fenced by the custody model. So very appreciative of the 2 odd years that I spent there. And then I went to another domestic boutique wealth manager called Kelly & Partners and headed up their alternative investment program. And then ironically, it was one of your events that I was speaking at while I was still with Kelly & Partners. And then I knew of Charlie, and I knew of what he'd done with the managed buyout with Viola, and kind of admired from a distance. And on the way to breakfast the next morning, he was asking me a bunch of questions. Halfway through it, I thought, I think this is a job interview, because he wasn't asking me anything about what I was talking about on stage. And lo and behold, it was a job interview. And then 6 months later, I was with them, and literally just finished the last Alts conference, now representing Viola, talking on the panel. So that's a nice 360 to end up back where we are.
We'll have to get all the exclusives, because we help make it happen. And look, I love the journey. And give us a little insight into your life as well. For people that see you as an investment thinker,
yeah,
what else should they know about Daniel when he's...
There's a few different flavors of Daniel, and I guess everybody at our firm probably just knows finance Daniel. So I'm a passionate musician, so I'm a singer and play guitar in a rock band. And musician Daniel actually predates finance Daniel. I'll stop talking about myself in the third person, but I went to the Australian Institute of Music for year 11 and 12, so I did my HSC there, but I've been playing guitar since I was 16 years old. So if I'm not kind of, talking about private equity and venture capital and all these interesting things that we do at work, I'll be recording at home with the band or playing live. It's just a shame that the Sydney live music scene isn't what it used to be. But we might have to do a joint event with the Inside Network. We'll see.
Oh, look, I love it. And you were saying that there's actually some flow-on effects and benefits of the two worlds. They're not just two different flavors that live their own discrete journeys. They come together for you.
I never thought that I would make that realization, but it was only the last few months. And it's mainly to do with the market-facing media stuff that I do on behalf of Viola, where there is a correlation between recording in the studio as a band and playing live. So what we're doing right now, kind of creating recorded content, if you want to call it that, very similar to the recording process that you would go through in the studio, where you're laying down tracks. And then when we're doing kind of more live TV, speaking on public panels and things like that, that's very much like playing live with the band, actually. So I'm quite comfortable doing this because I've spent a lot of time in my life on stage. I enjoy the process of engaging with an audience as well. That's why whenever I'm talking on a panel, I try and ask questions that get some type of reaction from the audience, because nothing worse than just being talked at for an hour. Ironic saying that on a podcast, because that's exactly what I'm doing right now. But, Sean, our CEO, and everyone in the firm is really quite motivated to increase the level of financial acumen that the broader Australian population has. It's something that I'm personally very passionate about, because quite often the case, particularly with high net worth wealth management firms, they build their firms and their practices in the darkness. And there's so many things that we're experts at what we do, and we should be sharing the lessons with the broader Australian population, because it not only helps them, it helps us, it helps the whole country. So we're going to be doing a lot more of that, and I think it's incumbent on us to share our skills and experience with the population.
It's a really laudable vision, and I also recognize that there is that nature of the way that humans discourse, which is that when you get really smart people in the room, there's almost a credibility kind of escalation, and who can use the most acronyms in 1 minute, because that's kind of just a way people connect. But actually, you have both that ability to understand finance at a very high level, but also to explain it and keep it simple is a really powerful thing. So what is that investment philosophy? Because it obviously permeates everything you do at Viola Private Wealth. How did you come to form it, and what are the key strands?
Yeah, first, it's a really important point that you kind of raised, that quite often the case in finance, people in my position or similar feel like, any public speaking opportunity is just a time to flex about how smart they are, and they try and cram as many ratios and acronyms and things in there as possible. And they end up losing the audience. And you end up, eyes glaze over in a room. And particularly for our clients, not all of them worked in financial markets to build their wealth, right? And I spoke recently on another podcast about how the Australian entrepreneur is very different to the US or European entrepreneur. Australian entrepreneurs are kind of good old-fashioned widget factories, sometimes in Western Sydney, that might have run an orange farm, amazing at what they do, but have no idea about finance. And so if Charlie or Pete or Angus or any of our advisors kind of get me into a room to talk with a client, I need to engage with them on a level that they can understand, and to kind of simplify complex topics as best I can. And that's the way that you engage with the audience. But as far as the model that we've built, so we trademarked this, and it's called the Core Squared Satellite Asset Allocation Philosophy. And so I'd observed kind of a few different models at different firms that I've worked at in the past before, taken the pros, left the cons, and kind of built what I thought was the most efficient way to manage capital. And a lot of this has taken into account innovation that's happened over the last even 2 to 3 years. There's been a lot that's changed, particularly with access points into private markets. Open-ended evergreen vehicles have allowed the average family, when I say the average family, we are investing for the high net worth segment. So that's kind of someone with between $2 to $5 million would kind of be a typical client for us. It's allowed the average family to invest in a way that only the very largest pension funds and institutions used to. And so this type of model, if you tried to invest with the Core Squared Satellite model 10 years ago, you absolutely could not do it. Sure. And I think that we've been quite innovative with this, because any firm that hasn't revised how they think about asset allocation within the last 24 months, I would argue in some aspects they're behind the 8 ball. And so the way that this has been built is the core satellite model is pretty well known in finance. You typically have a core of stocks, bonds, and cash, which is your traditional asset class core. And then the satellites is the alternative investments that kind of orbit around that. We've kind of taken that one step further, and we have 2 cores. So again, we have a traditional asset class core, stocks, bonds, and cash, but we have a semi-liquid evergreen alternative investment core, which benefits massively from the capital at work concept, whereby you can deploy 100% of your money in on day one. That is then compounding in a time-weighted return nature, the same way that if you invested $1 million into the NASDAQ 100, that full $1 million goes in day one. And so you benefit from a multiple on invested capital perspective. So to put this into context, a traditional drawdown private equity fund where you might lock up capital for 5 or 10 years, even if that's generating a 33% IRR, which would absolutely put it into the top quartile from a Cambridge Associates perspective globally, that equates to only needing an 18% time-weighted return in an evergreen structure. So by building it this way, we're building more liquidity at the portfolio level, and then we still have a sleeve of alternative investments, which is the satellite alt sleeve, because when and where it makes sense, we still want to look to lock some portion of the client's capital up for 5 or 10 years when those opportunities are really attractive. And so we're kind of building all of the different structures that are available in capital markets now into the one portfolio structure. it's going to allow us to generate we think between 200 to 400 basis points or 2 to 4% additional return over a traditional portfolio structure with better liquidity and lower risk. And so we're really proud of that. We trademarked it. It's not to say that that's going to stop other firms from using it. We would feel humbled if other firms adopted this, and I think they should consider managing money in a similar vein. But it's a massive competitive advantage that Viola has over our competitors.
So you are living up to the brilliant investment thinkers
tagline
there. No, it's fantastic because, as you say, I think it's a complement to the model if it starts to be imitated. Now, one thing that fascinates me, Daniel, is you live in that beautiful world of, each family, each client will have their own wishes. That could be at, the product level. That could be at, what the underlying assets are. So how does it look like working with a team of brilliant advisors to say, hey, look, this is the model, but also you've got parameters to be bespoke? How do you square that circle?
The Macquarie motto, freedom within limits, probably is a good way to describe this at a broad level. So I'm very lucky that I work with, in my opinion, the most talented group of advisors in the marketplace, and they're fantastic at what they do, and no one understands their clients better than them. It's not my job to tell the advisor what is right for their client, because that is why we employ them. My job is to select asset quality that ensures we're not going to impair client capital, that we're doing correct due diligence, that we've got a philosophy about how we manage money. But at the end of the day, the actual implementation of our investment philosophy and strategy is down to the relationship and the magic that happens in that room between the advisor and their client. And it's also something that we want to be a home for, future talent from the advisor market is concerned. And so if we implement too many restrictions on the way that they can do their job, that's also not in their interest or the client's interest. So we run a completely agnostic, open-ended architecture from a fund selection perspective. So we're not tied to any particular platform or solution. Means my job's way harder because our investment universe is the entire investment universe, but we want to keep that funnel as wide as possible to look at all the opportunities. And then our filtering and our due diligence process is what ends up with quite a concentrated list of funds at the bottom that the advisors are then allowed to use. And so we have a two-tiered framework about what's on our approved product list and then what we call a high conviction list, which is kind of a more synthesized version of that. But the nuance that you get client to client is where the fun of our game comes in, right? And I need to remind a lot of people quite often that we're not the future fund, we're not Harvard or Yale, that we're managing one pool of capital. And so we can decide that, 10% into private equity is appropriate. And I get asked that question all the time. How much do you do into this? How much do you do into that? The truth is there's not one answer because it's totally specific for the client that's in front of you. So I was talking before about that core squared satellite model. We might get a mandate from a client that says, I only want you to buy listed securities. And we can build a portfolio that does that. We also might get a client that comes and says, I only want to use you for your alternative investments. So we can build a portfolio that does that. A client might come to us and say, look, the mandate here, the objective here is to aggressively grow capital at 20% or more per annum. And so long as they understand the risk and that you're going to have to lock up a portion of money, we can also build that portfolio. So the word bespoke gets thrown around too much in our industry. We don't have a cookie cutter approach where there's, portfolios A to D on the shelf and you get to just choose one off and there you go. And we call it bespoke. We are genuinely building bespoke portfolios for whatever clients are in front of us.
Danny, you've captured really nicely the idea that these are truly bespoke. Question now, you're obviously passionate that there's alpha that can be generated with the core squared model. How do you think about fee budgets in this? Because presumably the advisor's still got a lot of scope to interpret this differently.
Yes,
but
absolutely.
Fees eat into the alpha that you're hoping to generate. But likewise, you can't achieve what you want just by loading up on passive strategies. How does it work?
Yeah, really good question. I think that the industry, and it's a little bit different for retail clients compared to wholesale clients, right? So that's probably two separate conversations. But I think that the industry focuses too much on fees, and it's the net of fees return that we should be focusing on. So long as the net of fees return is commensurate with the risk that we are taking for that strategy, I'm completely happy. We just finished a meeting with an amazing venture capital fund that we invest with. And the reality is you cannot invest into these markets without paying a lot of fees. It's literally just the ticket to the game. So you're expecting on average, a 2% management fee. There's normally a 20% performance fee above some hurdle. We have a specific section in our due diligence template, and I write an entire page for the guys to read on the fees that a manager charges. And I will mark them down if they're kind of not fair. Or what we see quite often is the hurdle rate being really low.
Sure.
So I came across a US hedge fund manager that will remain nameless, but they set their hurdle rate, and they were charging a 20% performance fee above this hurdle rate. They set their hurdle rate at 4.5%. So I went back to them and said, so hypothetically, you could invest the entire fund into 30-year US treasuries and generate a performance fee, which is a risk-free instrument. That's not right. So long as the hurdle rate is kind of fair for the strategy, the net of fees return is giving us a good risk-adjusted return. And it's also important to say, we don't want to take going concern risk on the manager themselves. I want that manager to be a profitable business in and of themselves, because I want them to be around in 5, 10, 15 years' time, because they need to be managing our clients' capital for that amount of time. So I've got no problem with them making good money, and to make good money, they have to charge fees, so long as the return is commensurate with the risk. With retail clients, it's a little bit different, right? Because you do need to report on MERs, you do need to report on fee budgets. And so we actually run two streams of our APL. We have a more retail focused stream, and a lot of these we use kind of, listed investment trusts or primarily listed investment trusts rather than companies, which are a little bit better from an MER perspective. But where possible, we should be choosing the fund that generates the best risk-adjusted return, agnostic to fees.
The other part that I thought was really interesting is you want to have the universe as wide as possible.
Yeah.
That gives you scope to consider everything. But then that makes your life hard.
Mm-hmm.
What does it look like to try and navigate that? Like, where do you start? What are the guiding principles that say, all right, this is a priority to research, this is a little bit lower on the spectrum?
You start by saying no a lot. I've gotten really, really good at saying no. And so my job is more to say no than it is to say yes. And so it's more important that we steer the firm away from opportunities that are going to blow up clients' capital than say yes to opportunities that are going to generate an extra 2 or 3%. So I'd say of the opportunities that we get presented, and I wrote a post on LinkedIn that kind of went a little bit viral on this topic to remind managers that their pitch deck is not the only one in my inbox at any given time. We probably get, and we're lucky, and I'm never going to complain about this, we probably get between 15 to 20 new investment opportunities a week sent to us. So that is that wide funnel that you're talking about. And I like the fact that it finds its way to us just because of our brand reputation, the fact that, particularly Charlie Viola, our founder, is well known for investing in private markets. And so a lot of fund managers know who we are. But we have quite a sophisticated 3-step process that we put a fund through. So first is an initial screen, and there are some kind of green or red flags that you can immediately rule out a manager, right? So one of them being, do they invest in their own strategy, right? We have to see a manager putting money behind our clients. Otherwise, it wouldn't make any sense that they don't believe in their own strategy enough to put their own capital at risk. Number 2, they have to have generated alpha. So if you're going to be paying a manager, a fee budget like we were talking about before, it's just a come to work expectation that you're beating your benchmark or your index. There are a few others that we take a manager through, and straight away, I'd probably say 85% of managers are screened out at that point. From the filtered subset, we then put a manager through a full due diligence process, which is a very involved document. And I would put our DD framework up against the titans of the industry, the investment banks, other domestic managers. I'd say we probably do a more thorough, due diligence process on funds than most groups. And we mark it out of 10 metrics, and then we either score the fund a pass, a credit, a distinction, or a high distinction. We've chosen to set the bar very high for asset quality, and so we'll only work with managers that score a distinction or high distinction. So even if a manager is a pass or a credit, which a lot of funds would score that, we'll filter those out, not to say that they're bad funds. We just want to only be investing with the absolute best in the industry. So I'd say of the managers that we put through to a full DD framework, because of all of the initial screening, about 50% probably pass at that level. And then those that pass end up, on our high conviction list, which is deliberately quite a concentrated list of managers. And from lessons that I learned at firms that I've worked at in the past before, there is such thing as over diversification. I've heard it called diversification, but that's kind of a cringy term. But it is the case that if you think about, diversification at a portfolio context, and you take that to the nth degree, and if you held every risk asset in the world, you would actually diversify away all possible risk, and you would end up with the risk-free rate. Sure. So too much diversification is actually a bad thing. Sometimes when we are bringing clients from other firms, we'll actually see, 30 or 40 sometimes ETFs in a client's portfolio, meaning they hold thousands of underlying securities. At that point, you just own the market. Right, you would have been better off just buying one Misky World ETF and just calling it a day. And so you're paying fees on fees on fees for that. So we want to have that high conviction list. There's quite a concentrated list of managers, say between 40 to 60. Not looking at churning that list very often because we want to have formed long-term, relationships with those managers. But that being said, if they stop doing what's written on the tin, then we'll make a change. But I don't ever want it to our approved product list to represent or resemble a phone book. Otherwise, it's just ignorance from our part, and we should be selecting with a little bit more discretion.
Daniel, this is 1 year in to Viola Private Wealth, so that gives us a sort of yardstick. What are you looking at in the market right now as for, you're looking for that 2 to 4% outperformance of a traditional asset allocation.
Yeah.
A lot of it's the model, but are there parts of the market, and that could be subsectors, geographies, are there things that you're favoring right now that you think are compelling, that you feel, hey, look, I want to spend more time looking at this asset class?
I get asked this question a lot. The honest truth is that we probably, if I was thinking about a bottom-up versus top-down philosophy and how we manage money, we're probably 70% bottom-up, meaning asset quality, fund manager selection, ensuring that the assets that we're putting money into are high quality. Top-down, which is your kind of macro overlay, what's happening with inflation and interest rates, we do take that into account, but it's probably 30% of our framework. And I think that mixture is probably right. I've never met somebody that has an amazing track record of picking macro events. It's notoriously difficult. Howard Marks had a fantastic quote about this after Donald Trump won the first election. And the market thought that he was the more risky play. And so if everyone remembers, when he got elected, the market started selling off very heavily, and then within a few weeks went on one of its most amazing bull market tears. So Howard Marks uses that as an example about how difficult it is to predict how the market's going to react to macro environments. I'd say if I had to pick some of the subsets of where we're focusing, it's using active management in the less efficient segments of the public markets. And so we're quite deliberate about where we use passive management versus active management. And we don't take an all or nothing approach. I've got no problem with using passive management in the more efficient segments of the market, which are the mega cap and large cap stocks. So the S&P, the SPY, or the NASDAQ 100 has done an amazing job at compounding money over the last 5 or 10 years. And I think it probably will, because you've got the benefit of the market cap weighting, rebalancing process, whereby the best companies and the largest companies that are growing the most progressively are weighted more, and it downweights the losers. So I think that's a fantastic mechanism that you can access for just a few basis points.
Yep.
So we'll save some of our fee budget by using those, and then we'll use active management where it seems that managers can much more reliably produce alpha in those less efficient, less analyst focused on those segments of the market. And Australian in general is a small cap market compared to the US, right? So we use active management there, and we're using more active management in those segments of the market. And then in the alternative sleeve, I think domestic venture capital is really interesting, actually. And I was in a meeting with one of the large US VCs just a couple of weeks ago, and I asked them if they knew what the ESV CLP program is, which stands for Early Stage Venture Capital Limited Partnership. So this is a tax incentive that the Australian government has rolled out to essentially make gains generated in qualifying ESV CLP funds tax-free. And they're doing this because they want to encourage more capital to go and fund early stage, technology innovation and get away from mining and banking, right? We need to kind of grow that segment of our market. So on a tax-adjusted basis, even if an Australian fund's doing, say, a 30% IRR, on a tax-adjusted basis, it compared to a US fund doing a 50% IRR. There's not a lot of people that are kind of aware of those benefits, and so we've made some strategic investments into that segment of the market. And then infrastructure. I think infrastructure is the new private credit. We went through the golden age of private credit for a few years there as a result of base rates being higher. That was paying out, equity-like cash flows, and we're still a very heavy user of private credit in client portfolios. But infrastructure really saddles nicely growth and income objectives. So you're typically expecting for an infrastructure fund somewhere between a 10 to 14% return. So again, commensurate with what you'd expect from a total return from equities, but you're getting 3 to 5% as income paid out along the way. Sure. So whether you've got an income-focused investor that's sitting in front of you, or a growth-focused investor, or a balanced investor, they probably should have an allocation of infrastructure, because it kind of saddles all of those objectives nicely. So we're kind of upweighting infrastructure. We've downweighted fixed income, I'd say within the last few years. And it was, somewhat of the philosophy of this firm before I joined, but the correlation between public equities and fixed income it used to be negative. It's not as reliably negative anymore. And so that volatility dampening effect that investment grade bonds would usually provide to a portfolio isn't as predictable or reliable. And so like Harvard and Yale, who have done the same thing, we've trimmed our fixed income budget and we've funded investment grade private credit with that allocation, which is why we're able to kind of have, on average about a 40% allocation to private markets, which might seem high. I guarantee you that in 3 to 5 years, the industry will be kind of where we already are, because it progressively is walking there anyway. And I actually think that there's quite a big difference between sometimes what a firm says they're doing in their model portfolios and what the advisors are actually doing. I've seen this firsthand. So we just do what we say we're going to do. And so, whether you've got an income-focused investor or a growth-focused investor, we'd advocate on average for about a 40% allocation to alts, which we can get away with because of the core squared satellite model that builds in a bit more liquidity than you would have had to do 10 years ago, where it all be drawdown lockup funds.
And just quickly on the infrastructure, private and listed, I mean, less and less.
Not listed.
Okay, because there's fewer and fewer options.
Zero listed. And the reason for that is because in the short to medium term, listed solutions and REITs are the same. They end up trading like public stocks. And so you're actually introducing quite a lot of kind of short-term volatility into a portfolio without any of the long-term benefits of going private. So our infrastructure allocations are exclusively private, primarily skewed towards North America and Europe.
Now, Daniel, you touched on that there's so many little tensions. You want to be at the forefront, but likewise, you want to generate that alpha. What does it look like to have some of those investable assets that are slightly outside of the mainstream? Are those things that you'll consider? Do you think about them? Do you read about them? So whether it's digital currencies or some of these NFTs that are coming through, where are they on your radar? Are they still years off from being researched properly, or will they never come? I just,
no, it's a good question.
Reflection for me is it came up as feedback from our alternatives event. There's no mention of cryptocurrencies. And I was like, well, to be honest, I don't know anything about them, so it wouldn't be a very good session. But, are they things that you start to think, one day, or, what would it mean? What are the hurdles that those sort of assets need to?
I think that Bitcoin is kind of there from an institutional holding perspective. There are a lot of institutions and corporates around the world that now hold Bitcoin on their balance sheet as a store of value. Where the difficulty comes, and I think this is going to be a big bridge to cross for any advisor group or wealth management firm or private bank. Bitcoin lacks some fundamentals that I can talk about. So, if a client comes to me and says, hey, what do you think the intrinsic value of CSL is? I can look at cash flows. I can look at EPS growth. I can look at market share. I can look at what the margins have done over the last 4 or 5 years, and I can come to some reasonable assumption about the future growth prospects of that business and therefore a stock price. And you can apply that to any other revenue producing asset like infrastructure or private equity. It's difficult for me to tell a client what I think Bitcoin is worth because it's somewhere between zero and who knows, $1 million or $2 million a token if people keep buying it, possibly, but who knows, right? I wrote a piece for another finance article the other day, and it was specifically on my thoughts on Bitcoin. And I said exactly the same thing. That's a technology that's quite old now, and it hasn't been used for arguably what was its original intended purposes of being a global currency. And so we'll buy it for clients if they want to hold it. It's difficult for me to put it on an APL and have a firm view that I can stand behind, backed by fundamental research. And so similar to gold, it's also difficult for me to speculate on what the gold price will be in 12 or 18 months because it comes down to supply and demand dynamics and greater fool theory. These assets will continue to rise so long as there is the greater fool that wants to keep paying a higher price for them. It could be something that eventually, we end up holding 5% or something in a client's portfolio. We'd prefer gold for now than Bitcoin, just for the reasons I outlined before. So it's a bit difficult for me to stand behind, a research-based view, but you can't argue with it's one of the largest asset classes in the world now. It overtook Meta from a market cap perspective. So it's a big asset, but just because it's big doesn't mean that it deserves a place quite yet in client portfolios, I'd say.
I feel reassured I'm overlooking it. Daniel, you obviously think about investment beliefs in terms of at the firm level. What does it mean to have correlations? How are we going to outperform a benchmark? What value are we adding? Clearly, they're set really nicely. You've trademarked it. And it's the sort of thing that, let's imagine 5 years from now, people are invoking.
I'd love that.
Squared.
Yeah, that would be amazing.
But what would cause that to evolve? Would it be market events, asset class correlations? Would it be new assets coming available? Because you also reference, fixed income's getting dialed down. I don't think you're the only person thinking that anymore.
No.
So what are some of the things that might make you think, okay, now I need to keep evolving and keep improving this model?
The core squared satellite model, the framework isn't rigid, and so it can evolve within the individual sleeves, and it's more about what we're populating the individual sleeves with, right? So for that semi-liquid evergreen alternative sleeve, that'll typically be about 30% of the total allocation of private markets of 40%, but what we're populating that with might change. But the purpose of that sleeve within the client's portfolio, I can't really see unless it's difficult to speculate on innovation that hasn't arrived yet, right? I'd have to assess it when it gets here. It's possible that we'd take into account something that happens in the future, but within those sleeves, we can change the way that we want to manage money. With traditional asset classes, if for some reason the macroeconomic environment dictated that actually we should go all passive with our equity allocation, we can do that without changing the core squared satellite model. So it allows us to move, the puzzle pieces underneath the framework that sits over that without having to change the entire philosophy behind it. And we need to have that flexibility because, a lot of these 60-40 portfolios and the framework that was behind these are 40 or 50 years old. Right? The world's a very different place back then, and financial markets were a very different place back then. So as Apple releases a new iPhone every couple of years, we should also be looking at our asset allocation philosophy and making sure that it's appropriate for the world that we're investing into.
So let's round us out. If I think about the firm being in a sort of a milestone event, what does the short run look for you and the team? Are there any things that are on the horizon that are targets that you're working towards? The financial literacy component. What excites you about 2026 and what lies ahead?
A lot excites me about 2026. I think there's a massive opportunity for disruption in our industry, and there's a lot of consolidation that's happening. There's an amazing supply-demand dynamic that's just present with financial advice all across the world, but especially present in Australia, and we're going to be beneficiaries of that. I think I'm really just excited to kind of see this firm fulfill its full potential over the next few years, and that entrepreneurial side of helping the guys to grow and run this business is what gets me out of bed every morning, with a huge amount of excitement. I'm really looking forward to advisors from other firms that are talented coming and joining us. And we'll celebrate those along the way as we go. And then just building out the scope and scale of the research function as well to kind of ensure that we're capturing all of the most innovative, new opportunities that the marketplace presents us and institutionalizing the offering. When I say that, I don't mean institutionalizing it from a bureaucracy or red tape perspective. I mean institutionalizing it so that we never lose that kind of startup type DNA that a lot of us come to work with. We're not a startup firm, but we have the open-mindedness and energy and excitement of a startup. And I hope we never lose that. And I think we'll all work to ensure that we never lose that. If we can couple that type of philosophy along with the scope and scale that they're bringing on new advisors and fund, will give us, and I think, the world's our oyster.
It's going to be an exciting year, and we would love to have you back. It's been an outstanding episode. Daniel, thank you so much.
Thanks for having me.